So let's say you're a business owner and there is some opportunity for you for a paid project. Let's say it's a programming project. Some company wants to charge you a fee to do a new website or to improve your website or search engine optimization. Maybe it's an advertising contract with an outside provider to maybe do paid search on Google or to produce videos. One of the questions that comes up is how to determine if that expenditure, if that expense is going to be worth it. A lot of businesses will do the math and say, well, if it gets me one more sale for $1,000 and this thing costs me $1,000, it's worth it. And that's a complete fallacy. You will lose money in your business if you use that method to calculate return on investment for any expense. So we're going to take a look at a couple ways to actually determine the true profitability of any expense. In fact, in business, in all of our businesses that we run, we don't consider anything to be a business expense. Any money that we pay, any check that we write, any contract we do, the dollar amount that goes out from our company is not a business expense. It's an investment in sales. It's an investment in revenue. And if you define it that way and you state it that way, you will make sure that any dollar you spend ends up being worth it. You're not going to waste money. And again, we'll do the calculations here in a minute. But when you're talking to a salesperson from a company trying to sell you something, one of the first questions you'll hear come out of their mouth is, what's your budget? How much you got to spend? What's your budget? To try to get an idea of how much you can spend. There's no legitimate reason for that question. There's no legitimate purpose for that question for you as a business or even for them as a company, because again, if what they're selling you or what they're providing you is valuable, it doesn't matter what it costs if you have a return on investment. And a good answer, a good comeback for that is, well, you know, if this thing makes me $2 million, I'll spend $1 million. My budget's $1 million. But if it makes me zero, $1 is too much. I can't afford $1. I'm too poor to spend $1 on something that makes me zero. So that's my budget. My budget is $1 is too much for something that doesn't make me anything. $1 million is too cheap for something that makes me $2 million. So let's dive into the numbers. Let's suppose that you are a business that first you have to determine your profit margin. And any business owner will know pretty much offhand your profit margin. And the way you calculate that is you take your revenue, let's say you sell $1 million worth of product or service in the course of a year. You're a $1 million revenue business. And you take your net profit. So let's say at the end of the year, you look at your tax return and you had a $200,000 net profit from your $1 million business. Well, that's an easy calculation. You have a 20% profit margin. Apologies for businesses that this is economics 101, right? It's pretty simple stuff. But it's important to have that number before you go into any kind of negotiation or contract or even just evaluation of a service, a product, a resource, contract. It's going to be the most important number to come up with. So again, you have a $1 million business, you make $200,000, that's a 20% profit margin. 20% profit margin. Okay. So now this business comes along, this company comes along, and they say, look, we have this advertising opportunity. We have this programming opportunity. We want you to hire us to do customer service or outside contractor, whatever the expense is, whatever the payment is for. First thing you do is take a look and think about how many more sales? How many more transactions? How much more revenue that thing do you think is going to get you? How many more sales it's going to get you? So if you're going to do advertising and it gets you 10 more sales, and you sell stuff for $100 a piece, well, that thing's going to make you $1,000. 10 times 100 equals 1,000 more revenue. So this is where the trap comes in. A lot of businesses will say, well, this service or product or contract only cost me $600 and it's going to make me 10 more sales, so it's good. I'm going to make money off this deal. Well, not really. Because remember, from that $1,000 worth of sales, you only keep $200 because that's your profit margin. You might have materials, cost of sale, servicing, sales commissions, whatever goes into your expenditures, even fixed costs, rent, overhead, lights, all that stuff. You only keep $200. So in reality, that $600 expense only really netted you $200 in net profit. So you're already losing $400 on this deal. So how do you calculate a good ROI? Well, and you can be very transparent about this with the vendor, with the contractor. You can tell them, look, your thing costs $600. We have a 20% profit margin, which means we have to net $600 from sales just to break even on your service, which means we have to sell $3,000 more of business, of sales, to get back to $600 we paid you, right? 600 divided by 20% or times 5 is $3,000. And that just breaks us even. That means that we did all the work, we did the contract, we did everything, and we're back to square one. We didn't make any extra money off this deal. In fact, the only person that made money off this deal was you, because you got to 600. We just got our 600 back. So we're basically a jobs program for your company. So in reality, we need to make more than that. We need to make 800 in net profit or 900 in net profit. So we really need to have about 5,000 in sales, 4,500, maybe 4,700. So if you sell stuff for $100, you need to sell 47 new orders from this one thing. So if the service you're buying is $600 a month, for advertising, you need 47 more sales every month to make it work. Right? And here's a more simple way to calculate this. You can do an X factor. No, not the TV show. When I throw out the number of 20% profit margin, most businesses operate at about a 20% profit margin. There's some companies that operate on a little bit thinner margin, like 10%. Some intangible product businesses are maybe a little higher, maybe 30%. And I'm talking net profit, not gross profit, not revenue, not cost of sales, markup. We're talking net profit. At the end of the year, what you netted in cash versus your sales, that's your net profit. After all expenses, including your salary, including everything. So most businesses on a 20% net profit, that's a factor of 5 to break even. So what we do is we say we need a 10x return, or maybe an 8x return, to make this a worthwhile consideration, a worthwhile pursuit. Because if you have 8x or 9x markup on your expense, you'll end up being okay. So what does that mean? For $1,000 worth of expense, you need $8,000 or $9,000 worth of new sales to make that expense not an expense anymore, to make it an investment. If you don't get 8 or 9x, it is an expense. It's a loss. Something that costs you money. You're never going to get it back. Just throw money out the window. A couple other traps that you'll run into. People will talk about branding. It's good for branding. Or they might, or you might even get into your head, well, some of those expenses are fixed and they're not going to go up. If we have extra business, our rent's not going to go up. Our payroll might not go up. Some fixed expenses might not go up. Incremental business has a margin that's at the limit, at the edge of that margin, all profit. Well, let's talk about those two things. Let's first talk about branding, or an advertiser especially, or a website developer might say it's going to get you more visitors, more traffic, and it's good for your brand. Well, the day that your bank allows you to make a deposit of branding, or you can deposit visitors, then you can talk about that. The only thing that your bank allows you to put in your account is dollar bills. Branding is not cashable. Visits, clicks, visitors, likes, shares, none of that is none of that is depositable. You can't cash it at the bank. Now, some of that might turn into business, but that's what you have to measure, not how many more visitors you got, how many more clicks you got, how many more likes or shares. It might be good for your ego, but you can't cash it at the bank. And if you want to spend $1,000 a month for something for your ego, that's fine, but now it is an expense. It's not a investment in future sales. So make sure that you extend the calculation beyond just visitors. Visitors is a good thing you might need to know, but then look at what's your conversion rate on visitors on your website. If you get 1,000 visitors and from that you get, let's say, 200 inquiries, and you close 10% of those, you have a 10% closing ratio. That means 1,000 visitors, you get 200 inquiries, 10%, you get 20 sales. Okay, now you have a number to talk about. Sales, the only number that matters. So if that $1,000 expense gets you 20 more sales, it doesn't add up, right? It only gives you $2,000 in revenue at that $100 example revenue we talked about. So you can't cash visitors, clicks, likes, shares. Can't cash anything except for sales. And that's assuming the sales are as good as you normally get. They're not lower margin. They're not discounted. They don't have higher cost for fulfillment. If your new sales cost you more money to fulfill because higher customer service, then you have to redo your math. Now, let's talk about fixed expenses. A lot of times people will say, well, if I get 100 more sales, some of my fixed expenses won't go up. Yeah, my cost of sale will go up, but my fixed expenses won't. Well, that's true in the short run. In the first month that you get 100 more sales or 200 more sales, you don't have to add more staff, rent more space, have more, electric bill. You don't have to do that your first month. But if your business grows and continues with that sales revenue, you're going to have to add expenses. Your insurance might go up. You might need more space. You might need more employees. You're going to need more customer service staff. So you have to keep that 20% net profit in your calculations until it proves otherwise. Until you've gone a year or two with new business and a higher profit margin, 20% is still your benchmark. You can't change that number just because the dust hasn't settled yet on the new business. Because there might be other costs that you're not aware of that show up later because of that new business. Regulatory costs, who knows what it is. So yeah, the fixed costs don't go up. Look at it as a windfall in the short run. But you're going to have to work harder too. If you have a 20% increase in sales, everybody's going to have to work 20% harder. You might have to do overtime. Some people might be stressed out because they have to do 1/5 more work than they were doing the week before. And that might put a strain on your employees. You might have to give them raises. You might have to give them bonuses. You might lose a good employee if you don't account for their extra workload. So yeah, in the short run, fixed expenses won't go up. So you might have a little bit of a bump in your margin. But in the long run, you're going to have to make up for it one way or another. So keep that in mind. Always keep your margin percentage the same until a couple years goes by that you see that it actually is solidified as a higher amount. A return on investment isn't just a fancy abbreviation, ROI. And it's something that you really need to look at deeply to identify what do you define as return. Return is not just more sales. Return is net profit. An additional sale is great for money, but you don't keep all the money. Some goes to payroll, some goes to cost of sale, whether it's a product you have to manufacture or purchase. It might be a service you have to compile. It might be data that you have to buy. Every transaction has costs associated with it. It creates a liability when you sell something. It's good that you did, but your return on any expense that you have is based on your net profit percentage, your retention. So the next time you're talking to a salesperson about some expense, some opportunity, keep an open mind. Don't discard it altogether. Keep an open mind with that offering. But make sure that the return that you get, the reward that you get, the result that you get serves your purpose, not just the company that's trying to sell you something. Because otherwise, you're just working for them. If you sign up for some $1,000 a month consulting program and it makes you $3,000 a month in more sales, you might look at it as a success. But from that $3,000 at 20% margin, you only keep $600. So really, you're subsidizing that consultant $400 a month to keep him or her in business. Sure, that's not what your plan was when you woke up in the morning, to subsidize a contractor. And that's where a lot of businesses lose money and they don't even know it. They take on expenses, they get a little bit more sales, and they wonder why, gee, how come I went backwards? I was making money. I was making $200,000 a year net profit. My revenue went up to $1.5 million, but now I'm making $50,000 a year net profit. I'm selling more, but earning less. That's why. Because the extra expenses between the 1 million and the 1.5, we're all losers. All the expenses you put in, whether they're internal or external, sometimes it's employees, sometimes it's rent. Doesn't matter what the expense is, they did not actually get you enough extra sales to give you the net profit to support it. It gave you more revenue, but your revenue went up, your net profit went down. And that's a trap a lot of businesses fall into very, very quickly. You chase revenue without net profit. And it doesn't make you a bad business owner. It's very tempting. It's easy to do. It's very seductive when you see these fancy, flashy, really good apps or programs or platforms or whatever it is. And yeah, sometimes you have to put a little money out front and after a few months it comes back. But here's the other thing. If you have a platform or an expense that might take 5 or 6 months of expense before it starts returning revenue, that's fine if it's highly probable. But now you have to take the expense for that 4 or 5 months and roll that into your ROI, right? So let's do the math on that. Let's say you have an expense that's $1,000 a month and it takes 4 months for it to start really turning out sales. Well, you have to take that $4,000 that you spent and add it into the period of time you're evaluating. Let's say you want to do it for a year. Well, take that $4,000, divide it up over a year. That's an extra $300 a month. So now your net profit has to pay back not $1,000 a month, but $1,300 a month, because you have to roll that $4,000 forward into the following year to show a return on that money. Now it makes it even harder. What's 10x of 1,300? Well, now you're talking about 13,000, not 9,000 or 10,000. You got to get 13,000, which is 130 more sales a month, right? So don't let that delayed profit or delayed revenue throw you off and make it a bad decision. Roll that in too, because it's real money you're paying. It's real money. It's not monopoly money. You're actually writing checks. And even if you're not taking on new expenses, if you go through your P&L, everything in your chart of accounts, every expense, and look at, well, how many sales does this get me? You could do it reverse. You can do it backwards. And you can find things that are expenses that don't have a 10x return. Now, you might not think that maybe customer service or fulfillment or your loading dock or whatever it is has an extra sales revenue. Well, it really does, because it's necessary to keep some of your sales, right? If you have a customer service department that you said, well, they don't make me any more sales, I'll get rid of them. Well, if you did that, eventually you would lose some sales, because your salespeople wouldn't have the confidence to close deals, because they know they're going to get callbacks from customers that are upset, or you wouldn't be able to fulfill and deliver the orders that you currently are selling, and that would reduce your sales. So there is an indirect connection between some expenses and additional sales. But even if you're not looking at new expenses, roll it backwards. Look at everything that's on your credit card statement for your business. Is there a $50 a month subscription you have to some organization? Is it worth it? Does it get you, an extra 1 or 2 sales a month because you have their logo on your website? Is it Better Business Bureau membership that's $600 a year? Does that get you more sales? Is it upgraded web hosting? Who knows? You may be able to roll back a few things, because if you don't, you just end up accumulating all this debris of extra expenses on your P&L, and next thing you know, you have $4,000 or $5,000 or $6,000 a month in junk on there that's not getting you anywhere, and that's real money. That's an extra employee, or that's an extra $50,000 you can save over the year to invest in some larger purchase, or to have capital to carry you through a rough spot, or to take up an opportunity. What if there's a competitor down the street that is struggling and you can buy them out for 40 grand? If you have put away that working capital, you might be able to do it. So just because you're profitable and you have black ink at the end of the month doesn't mean that you can spend more money on something that doesn't make you anything, or that you can continue to have expenses that don't give you a 10x ROI. Don't fall into the trap of salespeople. Hey, all you got to do is sell one more and it pays for itself. That's not true. I got to sell 10 more for it to pay for itself. And you can tell them. We're very transparent with salespeople, and a lot of times it's eye-opening for them. And maybe they have enough customers that don't do that math that they can stay in business. That's fine for them. It's not good for their customers, but fine for them. But you can also tell the salesperson, do you ever wonder why you have to go out and get new customers every 6 months? Because the current ones either drop off or disappear because they're not making money off your product or service, and they may not even know it. They just know that we got to cut some expenses, then it goes away, right? Isn't it frustrating to lose a customer, to lose a client? Wouldn't you rather build something where when we write you a check every month, it's not an expense? We love to write you a check. If we're paying you $1,000 a month and making $10,000 in sales, you know what my response is going to be next time I write you a check for $1,000? How can I give you $2,000 and make $20,000 in sales? Can I buy more of you? That's where you want to be, and that creates a good mutual relationship with you and this provider of whatever service it is. And the salesperson will appreciate that if it's a legitimate company. They'll say, yeah, I want to have a long-term customer where I don't have to go out and resell and do this sales pitch, every 6 months to get a new customer to replace the one that lost. I don't want churning of my accounts. I want new customers. And that's why a lot of contracts you see will have a date, a contract period in it. Well, you're locked in for a year. You're locked in for a year and a half. Why would you need to do that? If this thing is making money, why would anybody cancel? Why would anybody want to cancel? If it's as profitable as you say it is, who would need to cancel? Yeah, once in a while you might get somebody who's stupid and doesn't realize they're making money off of your service, but you don't want that kind of client anyways because they're stupid, right? If your product is this good, your service is this beneficial to my firm, I would never want to cancel. Matter of fact, I want to lock you into a contract so you can't go anywhere, and I want to pay you more than $1,000 a month. So look at contracts and ask them, why do you need this? Why would somebody want to leave? It's a good negotiating point too. I see in your contract it's locked in for a year, 1 year term commitment. Why would you want that? Why do you need that? Why would anybody want to leave? And they're going to stumble and mutter. They're not even probably going to know. It may not be they're doing anything wrong. It's just that they don't know that their customers are not making money off of their service. And maybe it's because most companies aren't that shrewd in how to use good resources. But that maybe that's the job of the provider to help them be more profitable. But anyways, look at your contracts, find out your ROI, start with your profit margin, divide your profit margin into the cost of whatever you're looking to buy. And the takeaway from this is nothing on your P&L should be a business expense. Everything should be an investment in revenue. No such thing as an expense. If it's an expense, you're just throwing money out the door. An investment in revenue is really the only thing you should be spending money on as a business.